I wanted to show you this website. We're going to talk about this one in a minute. I don't have time, but I'll do the summary of what we're about to cover here in just a minute. But before I do the summary slides, I want to find some trades. So if you go to BAR, there's a lot of places to find this information out, but if you go to barchart.com and you click stocks, and then you click pre-market trading, and this is where the juice is in the morning, finding stocks that have gapped up or gapped down pre-market. And so when I go here, I'm always looking at the price. Now, generally, $5 is the minimum price before any of this makes any sense. All right, so if I'm looking at this, I would only be considering nanobiotics. This one on IEP, I checked that one out earlier. CD, China, Helen of Troy, this one I like. We're going to talk about that one. And then down below, same thing. And one here that I like is Advanced Auto Parts. Now, although the stock hasn't gapped down that much, there's a reason I like Advanced Auto Parts. And the other one, I believe, was FMC. Let me consult my notes. Yeah, FMC. So right off here, we got three potential opportunities. Now, the one I want to start with is FMC. Let me show you why. So you want to check the news here. And what's important to note is that not all these necessarily have options. So before you get too excited, let me take this to a daily chart. Before you get too excited, make sure it has options first. I've done this the wrong way around, where I'm looking at what I think are great trades, and then there aren't any options. So check that first before you get yourself invested in this as an opportunity. All right, so it does have options. Slippage is, I'd say 20% max. That's $3. I'm not too worried about slippage on these. In fact, I'd say a good rule of thumb is make sure it's 20% or better. Normally it's 10% for us, but on these in the morning, we're going to be able to take advantage of that wide slippage and get a fill with all this crazy news. So we'll go through this process on FMC. So here's the stock chart as of Friday. And you can see here, the pre-market price is 96. What? So the stock's down here. It will open down here. If you want to see it in Thinkorswim, you can go to a 5-minute bar or a 1-minute bar, and you can see that's where we were on Friday, and this is where we are today. All right, so you can actually see the chart, or you can just look right up here and estimate where the stock is going to open. Now, if you look at the news, now this is really important. The sniper approach is to find stocks that are moving big, and preferably on really good news or really bad news. And so this is the worst news a company could put out, in my opinion. FMC slashes outlook, didn't lower it, but slashed it amid abrupt customer inventory reductions. Okay, bad news. There's blood in the water. Let's snipe some profits. You got to have one of these around so you can wipe the saliva from the corners of your mouth. It's really important that you get one of those. So now with the stock at 96, where am I going to sell? Well, support and resistance. Find a support and resistance level that would make some kind of sense. And I'm thinking right here at 102. The stock's at 96. The danger would be that the stock would close above 102. So that's as close as I would get on this one. And maybe a little higher depending on what we can get. So 102 is where I want to sell. What's available though? You go back to trade. Now this is going to have to be a 2-week trade expiring on the 21st. So ideally it's a 7-day options, but we'll get more premium here. And now if I look here, I can't sell at 102. Let's change this to vertical. Now the stock is at 96. That's 10 points lower. All right, let's just see what it comes out at here. I would sell the 100 if we got enough credit. Let's try to sell the 105. Let's go as no brainer as possible. Now I'm going to put an order in. So I'm going to guess the rough credit on this trade would be 10 points higher. I don't know how much we're going to get here. The option price, the options haven't opened on this one just yet. So I'm going to put a line in the water for $1. We're not going to get $1. I'll tell you what, let's do 50 cents. The prices will open up here in a minute. All right, now why am I doing 50 cents? Well, for a $5 spread here, 50 cents would yield $4.50 of risk. You take the distance between the strikes, 5, you subtract the credit, 50 cents to get your risk, $4.50, and then you divide 50 by 450, and then your rough return on investment is about 11%. I'll take that over 11 days. I will. Okay, so now the mid price is at 60. It just came up. I'm going to go for 60 here. Oh, I got to get my contracts. I'm only going to do one of these because I want to keep my risk down. Now it's at 77. Good. Let's go for 80. Are we going to get filled? I don't know. We're going to now it's down to 17. See, it's a fast game. Let's ask for 50 and see what we get.
Mike, what strike prices are we using?
105. I'll put it in snipers. 105 is the short, and then 110 is the long. Sell the 105 call, and then buy the 110 above. I'll put that here in snipers if you have access to that. And it's already down to 7 cents. We're not going to get it. Now, had I not been speaking, I would have had that order in before the market, and we might have had a shot at getting 50 cents when the feeding frenzy starts immediately when the market opens. At this stage, at 7 cents, 50 cents is my minimum. I'm going to hit confirm and send. Now, the one other thing we could do, let's take a look at the stock chart. Okay, now it's bounced from the open. 105 is up here. Yeah, I don't want to sell at 100. You see that? The stock's, you know, it opened here and it's already higher for the day. It looks like it might very well have a bit of a run up over the next half hour or so. If you see a stock that tanks and then keeps going, that's ideally what we want. So it looks like there's a bit of a bounce here that's happening. And for that reason, I'll just leave this sitting out there for 50 cents one time. And that's so far away. Go back to monitor here. Yeah, it's already down to 2 cents. So we're not probably going to get filled on that, but let's go find another one. Here's the other one. Yeah.
We have a suggestion from one of our newest students, and a brilliant one. It's Jessica. She say, I have something I think we can make some money on and not hold on to for long. I think Matt will go up even more with the new Barbie movie. I just can't find the best trade to make on it.
All right, yeah, let's look at that one in just a few minutes, but I want to get this other one off. I got 2 others, and then we'll come to you, Jessica. Thank you for the heads up. Here's ADP. ADP's down today. It was on that list. AAP, excuse me. Advanced Auto Parts, AAP. So now I don't like it as much anymore. What I did like about it, it was on the list. It's got some bad news. It got downgraded from neutral to underperform. That's just shy of a sell rating. And companies, that's not good. That's bad news. And so although the stock hadn't dropped that much at the open, it is recovering. What I thought would be a good trade would be to sell a call spread right at resistance. So resistance being 70. Now because the stock has bounced, I'm not as excited. I do think 70 will hold, especially given the underweight rating, which is terrible for a stock. Doesn't look like the stock wants to go anywhere. 70 strong resistance. So the trade here would be, and I don't like it right now, so I'm not gonna, I'll just tell you, let's take a look. I don't like it because the stock's rising. But the idea here would be to sell a Friday trade where you get 17 cents and risking 43 cents, which is, 20% roughly, 20, it's close to 25%. So it's a nice little return between now and Friday. Let me put this one up here, but I don't like it because the stock bounced after the bad news. So let me put it up there as a case study. The other thing you could do on this one would be a calendar spread or a condor. Now, I like a calendar spread right around 65 or 70. And this one's a little aggressive. I do like it. I think that we're going to be fine if we sold a 70 call here. But this would be a good candidate, as I was saying, for a calendar spread with the short strike at 70, with the both strikes at 70, or sell an iron condor between 80 and 60. So we've talked about both those strategies in snipers. If you go to the snipers dashboard, your snipers dashboard, or even YouTube, you'll see those sideways strategies detailed. So check those out. Check those out. Now, the other one I want to cover is Helen of Troy. So they just had earnings. The stock surges after profit and sales fall, but beat expectations. So they beat earnings. You can see what they are here. Now, what I always like to see is a guidance rate lifted. So I'd have to look through here a bit and see if they raised guidance. If somebody could look for that for me, that would be extra, like a cherry on top. But now it's the same thing as before. The stock gapped up after good news, beating expectations. It's come down a little bit. So it's vacillating up here. So the next thing to do is, well, where's support? Where do I want to sell? No closer than 120. Ideally 110, 115. So I'm just looking at support, 110. That would be ideal. If we could get a 110 credit spread, that would be ideal. Let's see what's there though, and see what we have to play with. So I've got the in Thinkorswim, I've got vertical spread shown. Look at that, slippage is nuts. All right, so slippage is so wide right now. We're not showing a mid price of $1.98. They're not going to give that to you because that would guarantee you a 98 cents profit. If you sell a $1 spread for that much, you have a guaranteed profit. And then brokers won't do that for you. Unfortunately, they'll do it the other way around. They'll let you buy a spread for more than it's worth. They'll do that for you. All right, so the mid price is pretty wide. Let's just see if we can get, I don't know, let's change this to a credit. It's showing a debit because of that gargantuanly negative bid price. So let's see if we can get, I'll put an order in for 50 cents. Let's see, what do we want? 50 cents? No, that's too high. How about 25 cents? Maybe we get filled. I'll take it if you give it to me. But until the market makers normalize the data, we're not going to get a really good reading at what the mid price actually is. So we're going to go for 25 cents. That will leave our risk at 75 cents. That's quite good for a trade that expires on, it's very good for a trade that expires on Friday. Let's take our contracts, 25, that would be 75 10, let's just do 5 of these. Let me post this one. I'll have to change the price most likely. I'm just dropping a line in the water, see if I get a bite. If we don't, that's okay. Then I'll simply change the price. So I just put the order in here under monitor. Slippage is gargantuan because FMC. Am I in the right stock? I'm on the wrong stock. Goodness gracious. I thought, no, wait a minute. Did I must not have hit send. Let me try that again. Back to monitor. There it is. That's weird. So the mid price is showing a debit until the slippage normalizes a little bit more. We're not going to see the actual mid price. Yeah, let's just take a look at the actual options here. The individual option spreads. 5 by 60. Okay, look at that one there. 0 by 470. Well, the slippage is just really too wide right now. We'll have to wait. I'm going to put the line in the water. I'll take the trade. If you want to give me 25 cents, I'll take it. Put a line in the water and then set it, forget it. Not necessarily forget it. Keep an eye on the stock, of course. But I got a line in the water. Am I going to get a bite? Maybe, and maybe not. Here's FMC going for 20 cents versus I'm asking for 50. So back to FMC, I'm going to adjust the prices a bit. Yeah, so FMC open here is it's actually lower from the open. So the question now becomes, how low will I go? So if I took 20 cents, which is what we could probably get right now, then my risk would be $4.80. So make $20, risk 480, not worth it. So let's leave it at 50. Maybe we get a lucky bounce. Now I'm going to show you the slides of what I just covered, and then we're going to go to Jessica's trade. So Jessica, if you could be ready with your analysis and tell us what you like about the trade you found. So this is grabbing short-term profits with gapping stock, usually pre-market, using bar chart pre-market gaps. These are slides that show you exactly what I just did. And so you can go to barchart.com and then just check. I went through this whole process. Keep an eye on the percentage gap, the price. Make sure the price is $5 or higher. 10 is better, higher is better. There's Helen of Troy. That's the one we just did. I haven't looked at some of these other ones here. The other one you could look at China data. I got to look at it now. Let me look at that one. That could be a good one as well. Does it have options before I get too excited? It does. It has options. Slippage is about 30%. A little high, but that's not necessarily a no-go. I don't see any specific news on this one, just that tech stocks are higher. Let's see. Yeah, just there's no news on China data. The market value of their outstanding shares is at 2.9 billion. Wow. Maybe that's what is getting people excited about the stock. So then it becomes, where do I want to sell? Well, 7 would be a no-brainer. What can we get for 7? Selling a 7 put. And we got a 750 put and a 5. These 11-day trade. Let's go to vertical. 750. Yeah, it's only 10 cents credit here at 750, which would mean our line in the sand is here. That's as close as I would get. And if I sell at 750, only 10 cents. So 10 cents on the width of the spread here, everybody, is $2.50, $2.50. So if you sold that $2.50 spread for 10 cents, your risk would be 240, nowhere near enough credit. Okay. And then we have the bears as well. Same thing on the bears. Okay, so here's the strategy guidelines, and you'll have these. This is what I just did. Identify pre-market gappers using bar chart. There's other ways to do that. That's a free site. You can do it. Verify the stock has options. Before you go into the rest of it, don't waste your time. This hasn't got options. You can't play it. Rule of thumb on the slippage is 20%, but I might go higher sometimes, depending on where the stock is and where the strikes are relative to the stock. And look for some really good or bad news. The good, the better or worse, the better. Is that a good sentence? I don't know. So verify with news. Ideally, you sell a 5-day credit spread or one, the options that expire on the Friday of the week you're in. Try to get at least 10% profit. Otherwise, maybe not worth it. Into the order within the first 5 minutes of the trading day. And then once you're filled, place a GTC order to buy the spread back for 10% of the original credit. And the stop loss, the hardest part is if the stock closes on the wrong side of the break even, meaning you're losing, then you close it out. Wait for a close. Don't hold on. This is the most important part. Although we haven't had to do this but one time over 32 trades, is you got to be really resolute that you'll do nothing unless the stock closes on the wrong side of the break even. And then when that happens, if that happens, well, when that happens, because it will, you got to get out. And you don't want to wait for another day. I'll wait another day and maybe the stock will go my way. That's human, but that doesn't work. So this is so important that you do that part. Be diligent. Just let the rules run it. Get out of the way, follow the rules. You can also backtest this strategy. It's hard to backtest it, really. Let's check the chat box. Okay, beginning. And then I'm looking at it.